hope you are doing good, and today we'll be focusing on the cost accounting terms which you need to know for the exams and test preparations. So these terms are very important because they will help you like get higher marks, get almost everything or everything is if possible correct. So these terms are very important to know, and also like you have to know how to interpret them correctly. So our first term, we have our break-even point. So break-even point is a point where the business starts making a profit, like the total costs are equal to the total maybe revenue that they have generated. So it is the point where the business starts making a profit. So by interpretations, I mean like you have to know if like what it means if our break-even point drops, decreases or increases. So I'll do interpretations on my next videos together with the past question papers. So we also have the fixed costs. So fixed costs are costs that do not change because of the level of output. They will always remain the same even if you produce nothing. For example, rent expense. Let's say you have rented a building but you don't produce. Obviously the owner will still demand their money, so they don't change irrespective of the level of output, irrespective of whether you produced or not. And we have variable costs. Variable costs are costs that like depend on the level of output. For example, let's say depreciation on your machine. If you don't produce, obviously it will depreciate less. And also your water and electricity, if you don't make more, let's say you are a baking company, you don't bake more, obviously if you don't bake more, you will not consume too much electricity. Therefore the cost depends on the level of output, whether you produce or not. And we have factory overheads cost. So these costs are costs that are not directly related to not directly related to our product, cannot be directly traced, meaning like you are they are required, obviously they are required to make the product, but they are not, you cannot identify them in the product itself. So for example, maybe you are plastic you use to put your oranges in, they are like overheads, you cannot trace them within your product. Then we have direct materials and direct labor. So direct materials are materials that are needed to make that product. So if for example you bake cakes, so your flour is your direct material, your oil is your direct material, and direct labor are people who are involved in making those products. Then we have indirect material. Indirect material are materials that are not directly traced into your products, like you cannot directly trace them. And also direct labor are people in the factory who are not making the product, but they are needed for the product to be made. Maybe for example the factory supervisor, he's just observing what is happening, but he is not making the product. So that's an indirect labor. Then you have to know the difference between FIFO and weighted average methods. So because sometimes they tell you the business is using FIFO, the business is using weighted average, so that you'll be able to calculate the closing stock of your materials, of your goods, your finished goods. Then we have cost of sales. So cost of sales, we know cost of sales from like our income statement. So it's an expense. So you know you need to know like cost of sales so that you can be able to calculate maybe the gross profit, the sales, whatever, when given the markup percentage. So we'll explain everything thoroughly in the next video.